Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite is Bailey McCann. She's a Wall Street Journal contributor. Bailey, thank you so much for joining us today at the MarketSite. Now, you recently wrote an article for the journal about CITs. Can you explain to us what a CIT is?
Yeah, so a CIT is a collective investment trust. It works somewhat similarly to a mutual fund, but you just have a different structure. So they're running a strategy of pooled assets, as you would expect, but you end up with getting a declaration of trust instead of a prospectus. And it's a little bit different in how it's regulated, but that typically means that it's also lower cost.
You wrote in your article that CITs have had a tremendous influx of capital over the last several years, almost $3 trillion worth. Why are they becoming more popular?
I think it's a couple of things. There's greater fee transparency. The fees are charged separately, so plan sponsors can put that out there to their participants. It's easier for them to understand. There's also, as I mentioned, lower overhead, and you know, there's more product innovation now in CITs. There's more strategies that are offered in this vehicle, and I think it's just being driven by, you know, we've seen a lot of plan participant litigation on fees and a lack of transparency, and CITs give you an option where you can kind of make that easier for people to understand and get it out there.
Now, with that $3 trillion of inflows, are you seeing CITs displace other assets or products in investor portfolios?
I think we're a little too early to say that it's at that level. But you know, some of the research I pointed to in my article shows that early data is that plan sponsors are picking CITs where they would have picked mutual funds in the past. I think in part because of some of the product innovation and the cost issue. So you know, over time, I think there's a long way to go before you really see CITs displace mutual funds. But they're making a gain. They're making a run for it.
You also pointed out in the article that there's one persistent problem with CITs. Can you explain that for us?
So CITs don't have a ticker. So you can look up your mutual fund on Yahoo Finance pretty easily every day and see, you know, what the price is, what the performance has been, get a sense of what the holdings are. You can get pricing information and those types of things from your 401k record keeper if you have a CIT in your retirement account. But you know, that's less obvious for people. But CITs have made strides to give daily pricing, improve that reporting, and make it a little bit more like mutual funds, because I think that's the sort of investor experience that you know, regular people have come to expect. But still, I mean, it's difficult to track. Right. You know, you can use mutual fund performance as a proxy if you are in a CIT that's also offered as a mutual fund, because they're usually one-to-one. But again, that's sort of a clunky way to deal with it. So I think, you know, there are firms that are working on increasing the coverage, putting more information out there independently of what the CIT providers are necessarily doing. But there's a way to go there.
All right. Well, thank you very much for joining us at MarketSite.
Sure.
Thank you for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.